in rally mode this week. The 10-year yield jumping to 145. And if you've been following the Chartmaster, that is the magic number he's been calling for. So where do we head from here? Let's get straight to the Chartmaster. Cornerstone Macro's Carter Worth to break it all down. Carter.
Well, you know, when someone says, where are we headed from here, which you said, my first thought is, I have no idea. Of course, so we're all in the dark to some extent, but let's try to figure it out together. I've got 4 identical charts and then 1 long-term chart. So the first chart you're looking at is just a 1-year chart of yields. And what's important is this. We know where we peaked, 177 on the 30th of March, and we know where we bottomed on the 20th of July at 1.12. 145, the reason that's been cited for months is that that's the midpoint. It's not only the midpoint, you can see in that first chart, it's exactly to the penny where the downtrend line, in effect since the peak, comes into play. Now look at the second chart, same time frame, but I've included the 150-day moving average, something I rely on heavily. Where is 1.45? To the penny at the 150-day. Third chart, it's charts 1 and 2 combined. So we have both the downtrend line and the 150-day moving average right where we are now, an inherently difficult level. A big move to a difficult level. Fourth chart, same time frame again, 1 year. And now I've drawn the opposite or opposing line. You have 2 converging lines here. Consensus is increasingly that we break out to the upside. My hunch is that we're not in a position to do that right here and now. Final chart, it shows the wedge in more sort of not detail, but more importance, how long term. This is the line that's been in effect for 3 years. I think having approached it quite quickly, rates back off at this point.
So buy Treasuries, Carter?
You got it.
All right. Carter, we'll see you in options action. Carter Braxton Worth. Would you agree with that take, Tim? Because that implies that we're sort of churning. You know, we're going to hit this level and then we go back down.
First of all, no one uses the term to the penny more emphatically and more convincingly than Carter. And I bet he used that same phrase at 111 on the 10-year on the downside in mid-July. I mean, Carter's made great calls on these turns. Hard for me to argue with Carter. But the question is the trend at some point ready to break? And we are at the up end of a downward trend line. I just think we're in a case here where inflation is going to be something we cannot fight. Rising interest rates of this week are a combination of the Fed and feed through. Listen to FedEx, listen to Costco, listen to everybody. And I think rates are moving higher. And I think it's very good for cyclical, industrial, bank, and even value-oriented equities, which had underperformed for months. So, again, my Treasury call is, like Carter, I'm not going to tell you exactly where we end up, but to me, the move is ultimately higher, even if we are oversold to the upside on yields, and you could see a bounce in Treasuries here. I would not be staying around for that much longer.
Okay, Brian, where do you stand on Treasuries, and what do you think the chart tells us about the economy, if anything?
Yeah, so that's the trillion-dollar question. I mean, it's hard to read too much into the bond market because it's so manipulated by the Federal Reserve. And I don't mean that as a slight. It's just the fact that they're buying bonds, right? So for me, I am short 10-year notes, right? So I think yields are going higher. I think we're going to get that breakout, primarily because the Fed just told you, hey, by the way, we are going to stop buying bonds in a little bit. There is some tailwind from buyers overseas, but that could easily reverse if you get any type of inflation scare, which I think we're getting once again. We've probably reached kind of the peak of the deflation scare. And with these supply chain issues, things will start to ramp back up. So that's my call on it. I could be wrong. Carter has been 100% right. I'm just hoping this one time maybe he's wrong.
Yeah. How are you trading Treasuries, Nadine, if you are?
We have been. You know, we've been pretty much trading the chop. And I think that's where I agree with Carter, is that on a very short term, we've been just trading them. They've been in certain bands for us. But I also now agree with Brian in that looking forward, if you're going to look for the next few months, we think that rates are rising. So we would be more inclined to be looking at high yields, LQD in terms of, you know, an ETF also that's non-high yield that we're interested in. But you could also play it in financials. You could play it in energy. So what this is all saying is if you think inflation's here for a while, and if you think the growth of GDP is accelerating, yields are probably going up. So you'll want to play it a different way than buying treasuries. But for a trade, Carter may be right.
Do you think yields are going higher based on higher economic output or accelerating growth, Pete? I mean, given what we heard from Nike and FedEx over the past couple of days, how are you feeling?
Well, it does make you wonder, Mel. I mean, we're talking about two major companies, massive companies, and giving us some lines, one about supply chains, the other about workers. I mean, it really does say a lot about what's going on. So I look at it this way, Mel. I think the 10 years is going to likely continue that churn that it's been in. But I think that the real meaningful thing will be the velocity of the move. I think it eventually goes higher towards the end of the year. As a matter of fact, I continue to see in the ETFs, I see the XLF with a lot of paper, all very, very bullish, looking to the upside and going out all the way to December. So when I see stuff like that, I think that the longer range tells me 10 years going higher. How fast it goes, I think that's the very meaningful thing. It's the velocity of that move. If it continues on this churning process, that's going to be very, very helpful for a lot of people. Other people, if it gets that velocity and starts shooting to the upside, we're going to see a lot more volatility come back into the market as well.
And that's the thing. We've seen the moves happen real fast when they do happen. I mean, even in just the past couple of days, Tim. I mean, what was the move in the 10? Yeah. Was it 15 bips or something like that? I mean, that's kind of unheard of in the course of a short amount of time.
You know, I don't know. I really don't think it is, and I really don't think it is from the levels that we're at. And I realize on percentage basis, yes, Guy talks about this all the time. I mean, look, the farther out on the curve you move, the more duration you have, and I don't want to bore people to death, but there's a much more significant move in terms of basis points. You have a lot more volatility. Seeing the move of 25 basis points off those lows, in the last week or so, I don't think is shocking given the inflation reads we've had and a Fed that signaled November is game on. By the way, two other major central banks, Norway, Bank of England. Norway hiked this week. Bank of England signaled that they could be hiking in the first quarter. You know, these are all reasons why rates could be moving higher. I don't think that the velocity, as Pete talks about and is watching, is something I'm worried about right now, the way they have moved relative to where we have come from.